Matt, I'm very excited to do this today.
Oh man, yeah, this is probably the best person we can have on the podcast given the state of the world today. And he also happens to be my favorite author. He wrote the book Crude Volatility, which is now the second book that I've read 3 times, along with Gold, Dollars, and Power. And it's the only book that I've read 3 times that I actually enjoyed reading all 3 times. This is just a fantastic book.
It is great.
2 quick notes before we dive in. A quick reminder that this show is for informational purposes only, and it is not investment advice. Daniel and I may have investments in the companies discussed.
Before we jump in, a quick thank you to our presenting partner, EQT Corporation.
At Backtest, we study market cycles because patterns from history rhyme. Understanding history gives you an edge.
Just like the edge EQT brings to powering AI, producing American natural gas to help deliver affordable, reliable energy at scale. Okay, Matt, you ready to go?
Let's do it.
Hello, everyone. Welcome to a very special episode of Backtest, the podcast about defining moments in market history and their timeless lessons. Today, we have the privilege of chatting with Bob McNally, the founder and president of the Rapid Energy Group, a leading energy market policy and geopolitical consulting firm. He served as a White House energy advisor to President George W. Bush and spent 12 years as a leading energy market analyst at Tudor Investment Corporation. He's also the author of the award-winning book, Crude Volatility, The History and the Future of Boom-Bust Oil Prices, which is one of our favorite books at Backtest. Bob McNally, welcome to the show.
It's great to be back, Daniel and Matt. Thanks for having me.
One thing that Matt and I were both excited to chat with you about is the fact that a lot of people seem to have been surprised by the strikes on Iran on February 28th, and also the impact that it's having on oil markets. However, you published a report 8 months ago in June outlining this exact scenario. And then 2 days before the attack, you published another report that said the odds of military escalation at 75%, which arguably is really high relative to the consensus at the time. And then a few hours after the strikes on February 28th, you talked to CNBC and you said that traders were underestimating the Iranian retaliation potential. And in fact, they quote you as saying that Iran could make Hormuz unsafe for traffic. It could spike oil prices above $100 a barrel. And that's exactly what happened 8 days later. This is not the first time that you've been right, that you've made a right call. You've consistently done this throughout your career. In fact, we covered that in our Shale Revolution series. So a good place to start is describe for us the mental models and what you're processing to understand what's happening faster than most people. How do you do what you do?
Yeah, thank you very much. And thank you for mentioning that history. Look, my job for 17 years at Rapidan and then 12 years working for Paul Tudor Jones at Tudor is you're like a hunter and you're looking for variant perceptions where your understanding of a reality or a situation or an outlook is vastly different than the consensus. Occasionally you just get really big whales. You get big ones. You know, it's obvious, you want to be the first to figure out something that's not priced in. But I step back and sometimes, once in a while, you get the collapse of what I call a load-bearing assumption. Could be in energy. Could be, there also in macroeconomics, finance, think of it as the dollar will never depeg from gold, or the Federal Reserve will never allow a private bank to fail. Those are load-bearing assumptions in finance and economics. Everybody's models and understanding of reality is embedded in that foundational key assumption, which is unquestioned. And to question it is kind of to dabble in the absurd, until just before it unravels, and then you deal with it. So in energy, we've had some load-bearing assumptions. About 10 years ago, a load-bearing assumption in oil markets for 90 years had been, whether it's Texas Railroad Commission or OPEC, somebody is going to prevent boom and bust oil price spike cycles. Someone is going to regulate the supply of oil. I can't imagine, so thought the consensus, a world, I know of no world, in which there's no supply manager. Because since 1932 until 2008, we had one. Okay. And I think what we're seeing now in Iran is the collapse of another load-bearing assumption. It's not just the outbreak of the conflict. We did call that. And we also called the June attack too. We had that tactical call right. But what really is surprising folks now is the duration. And so, we did this report in June. The first time we did it in 2019, that picture that I sent you, the picture online is actually a cover from our 2019 report. We did it in May of 2019. We updated it in June. We did it because in 2019, there was a lot of tanker battles and things going on, not as bad as now. In that report, by the way, I digress, but I'm like, I remember from my White House days that of all the places on earth and all the places in the Middle East that no one knows about, that's the most important, literally the most valuable piece of real estate on planet Earth, it was the Abqaiq stabilization plan. So back in, I think it was May of 2019, and my staff was kind of grumbling. They're a little bit like, I don't know why Bob is force marching us through this barrel counting, and Hormuz is out for 7 days and 30 days. And I'm like, I said, I did this for Bush in the White House. We're going to do this for our clients. And then I'm like, and by the way, I want us to have a side box on Abqaiq. They're like, what's Abqaiq? The hell is that? And we did a thing. Abqaiq, stabilization plant controls 7 million barrels a day, irreplaceable. Abqaiq was attacked in September of 2019. And then when we opened on Sunday in Asia, biggest percentage move in crude, except for the one we just had last Sunday. So that was a new record. So we got to June when we bombed Iran. I'm like, time to do a refresh of that work that I did again on this classified side for Bush, where we do the two things. You talk to the military folks and you say, what are reasonable scenarios for interdiction of flows? You give me timelines, reason, and say, okay, thank you. Are you sure? Good. Okay. And then you go to the oil side and say, okay, let's model the piping, if you will. If we lose Hormuz for these many days, if we lose Abqaiq, look at spare capacity, look at commercial inventories, look at redirects outside of Hormuz, et cetera, and just kind of figure out where the flow will go. And so we did it in June, and we started briefing it. And then I went to IE Week, so in London, International Energy Week, and all the traders, all the investors. And by this time, things are getting tense. And Iran was the top subject in all those meetings. And I was in dinners and meetings with traders, and I was in meetings with banks, I will not say, the room's full of people. I would say, they're like, well, yeah, Bob, what do you think? I mean, push comes to shove in Hormuz. I mean, what do you think? And I go, well, yeah, no, I think Trump is serious. And I think the Iranians think that Trump doesn't have the guts. So I think we're going to have a conflict. And I think the big surprise we discovered in 2019 in June was, oh my God, the military says Hormuz is going to be closed for weeks. And we can get into the why in a second. It's a game of whack-a-moles with thousands of moles. You can do it. Takes weeks. I'm like, the market is not constitutionally stable and emotionally prepared for weeks. Not of the math you do when you cut off 20 million barrels a day of oil and 20% of LNG. So I saw one of these variant perceptions. I'm like, oh my God, Planet Military tells us in a best case, if we get going soon, weeks. If they lay lots of mines, months. And then you go do the barrel counting, you're like, we're going to have the mother of all oil price increases. And then when I talked to my market friends and clients, I'd say, if this thing gets started, it could be weeks. And they looked at me like I was high on crack. They looked at me like I just said something like, I think the dollar's going to peg from gold, like in 1969, or don't ever think the Fed might let a bank go, 2006. They looked at me like I was crazy. Now, why? Why did they do that? I think two reasons. One, no one had ever shut down Hormuz before. Even in the 1980s during the tanker war, Iran, Iraq, hundreds of hits on tankers, hundreds of mariners killed. We never saw traffic interrupted in the Strait of Hormuz, number one. Number two, when you suggest that the U.S. military will sort of go all in against an adversary in the Gulf, your kind of mind snaps back to the last times we did that and what happened there. And go look at your screens, March of 2003, January of 1991. The oil price collapses. The U.S. military prevails completely in a matter of hours to days. And if you really know history, you'll remember April of 1988 was the last time we fought the Iranians. One of our destroyers had hit a mine, and so we sank like half their surface fleet and destroyed a few platforms in an afternoon. So if someone says to you, like I did, hey, it's not going to be over like that. They're like, you're questioning a bedrock assumption. I can't get my mind around the math. As one big bank said when they were asked, they thought about it. Someone asked, what about if there's a long-term disruption of Hormuz? Is it I week? Like they thought about it for a second. They're like, well, the oil and gas market can't balance. So Trump won't let that happen. No, that won't happen because that markets won't balance. And so therefore, it's not like Baba Mandab where you can go around. No, this one won't work. So therefore, it can't happen. Okay. So they look at you like, no, you're out of your mind. And so, and I still think the reason we're not even higher is I still think it's draining, but there's still this reservoir of just hope and disbelief that we're actually seeing this and that people are coming to grips with the idea that really
Yeah.
either President Trump's got to give up here or the military's got to come in and clean this up because it was absurd to consider that we would lose the world's most vital commodity artery, not just oil and gas. Anyway, and so it's a mother of all variant perceptions, and a load-bearing assumption in energy has collapsed for the second time in 10 years.
Yeah, one of the things that Matt and I have spent a lot of time debating over the years, really, since we worked in energy, we've also worked in finance and tech. And it's funny that a lot of people out there just misunderstand or underrate the importance of energy and oil in particular, which is part of the reason why we love the book so much, because I think it really sheds those assumptions and lets you see the machinery for what it is. You say in the book, or maybe the main thesis of the book, is that oil is not just important because of the relative magnitude, on the energy side, but it's also very important and fascinating and complex because of the intrinsic volatility in oil prices. What does that actually mean? Help us set a little bit of context as we dive into the history here of the oil market.
Yeah. Well, oil it's not one of the world's most important commodity, but one of its most outstanding, startling, dismaying, fascinating features is its extreme proneness to price volatility. And that's intrinsically because of the inelasticity of supply and demand of price. I mean, in the economic terms. So as I explain it to people, just on the demand side, oil is a must-have commodity for which there are no scalable substitutes. If movie prices double, you stop going to the movies. Your life doesn't end. If you go to the store and you're dying for a nice side of beef and it's tripled in price, you get chicken. You still eat. If gasoline prices go up almost $1 in a few weeks, as they have, what are you going to do? Quit your job? No, you're going to drive to work. And
Right.
it goes the other way too, by the way. It's not like, what would happen, if the price of exquisite Cabernets was to collapse by 70%. I don't know about you. I'm not even that much of a wine drinker, but I'd be going to Total Wine and my consumption immediately would adjust. I would go up, right? But oil, if gasoline prices were to fall to $1.50 a gallon, what are you going to do? Get in the car and say goodbye to your wife and kids and just drive to Schenectady and back or something like that? Just to drive just for the hell of it because gasoline is $1.50? No. So you have on the demand side, oil products that we use, gasoline, diesel, and you got to ship stuff. You want to have food lines stocked with bread, it's got to come on a truck using diesel. So it's the lifeblood of modern civilization. Our economy requires copious, unending, uninterrupted flows of energy, mainly oil and gas, and it's not discretionary. There you have it. So that means that to get people to not drive, you really have to have a big price increase. There's not a lot of discretionary demand to squeeze out. So when you need to balance the market because there's been an interruption like 20% of supply, you need big price increases to get folks to drive less, often so big that it actually has to slow GDP growth. That's why oil price spikes are often at the scene of a crime when we've had major economic downturns since World War II. And so on the supply side, same thing. And that's why we need the swing producer. It takes a long time to find, discover, develop, produce oil fields. And for that matter, build and erect the pipelines, refineries, distribution systems that bring those products to us. And once you've spent all the capital up front building that stuff, you use it to the max and you don't just switch that thing off when spot prices fall below even, you even fight it even sometimes if it's operating, but you don't go too far for that. But you don't simply toggle your supply. And so you've got a commodity where the production side and the consumption side are extremely insensitive or inflexible with regard to price. For any commodity like that, just happens to be oil, the most important one, whenever you have an imbalance between demand and supply, you necessarily will have a massive price increase or decrease to balance the market. It's just intrinsic quality of a commodity with those kind of features. And to banish this is going into, we talked about this before, it's my book about to suppress this, because other than for oil analysts, talented traders, and storage owners, we're the only ones who benefit from wild crude price volatility. Everybody else on the planet hurts and from that. So as much as we enjoy it, the world doesn't. And so you want to suppress that thing. And the only way we can suppress it is through this, what normally doesn't exist, flexible supply. And that gives rise to a swing producer like Texas Railroad Commission for 40 years, like OPEC and then OPEC Plus. But alas, here's the problem here. The swing producer today, which is mainly Saudi Arabia, UAE, a little bit of Kuwait, they're all blocked up in the Strait. So not only do we have the world's largest disruption in supply in a commodity for which demand is extremely inelastic, but the buffer that we were hoping would be there for disruptions is also blocked up in the Strait. So it's not a pretty picture. So just in history, we run the world two ways in oil. There's two ways since 1859. You either have an effective swing producer, in which case oil prices are fairly well anchored and fairly stable, with usually a recessions and wars to throw them off, or you do not. And when you do not, and my research shows, oil prices will oscillate between high levels that will induce a recession, because at the end of the day, if you have to destroy demand, that's the way you do it. And then low levels, low enough to force producers to shut in, which is low. Now, shale introduces a little more flexibility in that, like you saw in 2020 when crude went from like 60 to, well, at one point negative 37, but let's call it 20. We lost 2.5 million barrels a day of U.S. production in like 4 months. All you had to do is throttle back on the shale and the completions and everything, and the decline rates took over. So the U.S. shale, it doesn't replace a swing producer, but it does introduce a little more elasticity. But still, guys, we're on Space Mountain, and that's why.
I think everybody has a sense for OPEC as the entity, and OPEC Plus now, the entity that has tried to manage supply to some extent, manage price as a central bank might with interest rates. I don't think a lot of people have context, unless they've read your book, about the previous attempts. And certainly, I think most people don't have context about the fact that the Texas Railroad Commission historically was the most successful Texas Railroad Commission plus the Seven Sisters at managing price volatility.
Right.
Maybe talk a little bit about that. Give us a sense for how that came about, because in everybody's mind, Texas is always about limited government. Nobody here, I'm in Texas, nobody wants government regulation. And yet, the most successful attempt at regulating the oil market was done via the Texas Railroad Commission.
No, you're right. There are these delicious ironies in oil history. Delicious. I mean, they're uncomfortable sometimes, but they're so interesting. I work for a Texan president. I go to Texas all the time. I've had family members move there. I'm a Yankee from the Northeast, but I love Texans, and ask myself, why do I love Texans? And, I ask myself, well, why did God put people in Texas? And I think God put people in Texas partly, as you said, to produce oil and gas and limit the role of government. And I think that's great. And so, what irony that Texans and Oklahomans, I have to say, got to give them credit.
Yep.
They resorted to the most heavy-handed government control of any economic activity, I think, known to man. I mean, Mao Zedong, if he had seen how heavy-handed the Texas Railroad Commission is, he might have said, guys, leave a little room for the private sector. For Pete's sake. Guys are being a little heavy-handed, okay? I mean, to banish that price volatility, which was unleashed as big new fields were being found in the late 20s and early 30s, right? Prices down to pennies on the gallon. They resorted to quotas and price control that made OPEC, which later followed them, look like softies. 3, I think it was always gentlemen, if I'm not mistaken, at the time, in the Texas Railroad Commission would meet every month in Austin, Texas. It'd be hot, and there'd be other drillers in there, and they'd be angry every month. And they would have a look at, do what OPEC does now. They'd look at supply numbers and look at demand and look at inventories, and they'd do this and cross the T and carry the 1. And then they would just impose a quota. And in the 1950s, you had at one point 35% of world production capacity for oil kept off the market by regulators. 20% of that was in the U.S., 15% was by the Seven Sisters who were cooperating. And so imagine that. And the drillers would be angry. Damn it, let me produce more from my own well next month. Sorry. Too much supply, not enough demand, inventory is too high, you're staying where you are. See you next month. That's how we ran the world for 4 decades. OPEC meets every few months, whatever. I mean, these were, by the way, quotas put in place in Texas, well by well, field by field. And to get this rolling, because there was resistance, people resisting. There's all kinds of interesting stories of people making camouflage and subterfuge, like water faucets that were really oil. And when the inspector left, they turned the thing in the water and they black market. I mean, there's great stories of how people try to evade this communistic control of oil production, which is often done by small drillers. And you ask yourself, why would Texans resort to such heavy-handed government interference in private sector decisions? Why? Because they're not naturally inclined. It's because, as they had known, but we had forgotten, if you don't, you get something worse than government regulation. You get devastating price volatility. And this eventually, this is in oil states. This is schools, police departments, jobs, crime. This is the whole ball of wax. You just simply can't tolerate boom-bust oil prices for the lifeblood of modern civilization, especially in states where revenue and jobs are so dependent on the production of that lifeblood.
Yeah, is it fair to say too, Bob, that basically if you're a producer, part of the incentive process is that you understand after having lived through one of these that if the price collapses, you're probably going to go bust. You're not going to be around. That's extremely painful. And so maybe you're more, after you live through that, maybe you're more flexible to the idea of quotas potentially, at least for a while.
Right. You are. And you tend to see, I don't want to name names, but go back and look if you really want. I think it's a fascinating period. During COVID, I think it was May 2020, the price of oil is collapsing. And the Texas Railroad Commission had a 2-day hearing on whether to reimpose quotas. And I think it's a matter of record now, and they've been bought by Exxon, but Pioneer, more of an independent, smaller than the big companies, is kind of in favor. Exxon, not in favor. And I think that holds throughout history. What you have is smaller producers who've invested that capital, who maybe took that risk, the wildcatters. They've got this, they just want to produce as fast as they can, and sell. They want to make their money back. And it's the big companies, because they may have refining. And if you have refining, even if crude's falling, at least your feedstock's falling. I can make my money on the margin. So what you tend to see in history, as you say, I think bigger integrated companies tend to be more mindful. They've been around a lot longer, and so they know the history. This volatility imparts an imperative to integration, right? If you're a producer and prices are collapsing, if you've got refining, you can make some money on the way down. So if you're a smaller company, you want to make that quick return, you don't have that refining, you just want to produce that oil as fast as you can and sell it. So you're going to be more resistant to the government coming in and telling you to throttle back your wells.
Bob, take us back to the Texas Railroad Commission Seven Sisters time period and talk to us about spare capacity and like how that played out through the period where they were the swing producer. Why did that matter?
So this coordination started because just about the same time, a few years before the Texas Railroad Commission got in the job of supply management. So 1932, 33. In the late 20s, the 8 majors had gotten into a price wars, basically, and they were burning down prices. And so they got together at a castle in Scotland. I think it's called Achnacarry, if I'm not maybe mispronouncing it. And they all got together and they decided to cooperate on pricing. Now, they knew that if they just set their own prices willy-nilly, they could be subject to antitrust investigations and so forth. So they wanted to safely find a way to stabilize the price and production in a way that governments would be okay with. And so they started with this idea of let's do Texas Plus pricing. And let's agree, these are companies, BP, Chevron, the ancestors of Exxon, Chevron, say, let's agree, because we're all operating all over the world, Europe, Africa, Asia. Let's agree to price our oil based on the Gulf price in Texas of crude plus transportation costs. And we'll come up with benchmarks for that. So, Corpus Christi, whatever, to Milan or wherever. And then we will base crude and product prices off of that. And that kind of dovetailed nicely with the Texas Railroad Commission, a government agency, coming in and starting to stabilize the price of oil in Texas. So this is the way the system worked. You had Texas pinning the price of oil, crude oil, adjusting producing wells as necessary to keep the price stable. You had the big international companies agreeing that the price around the world will be based on that stable, controlled price in Texas, plus the transportation costs. And they agreed to share infrastructure and facilities, and they had monitoring and so forth, and it worked pretty well. Everyone agreed because it's like mutual assured destruction. If we start cheating here and everything falls apart, we know what that looks like. That's a meltdown in prices, and we're all underwater. So the system worked well. Now, then came the 1950s, and this was, 10 years before. Dan Yergin, the great Dan Yergin, a mentor and a friend and a towering, the historian in oil markets, who's been so great to me and gave me a plug for the book. He talks about the hydrocarbon man, the demand boom in the 1960s, right? But that was the 1960s. But before the 1960s demand boom, when everyone was getting in cars, every rock and roll song was about a car, by the cars. I mean, everything was cars, cars, cars. Baby, you can drive my car. I can see for miles. I mean, it's just, before that in the 50s, we had a supply deluge. We were really starting to produce oil in Saudi Arabia, and the Soviet Union started to produce, and we found a little oil in Libya. So before the big demand thing, a decade before, we had tons of new supply come in. And this proved difficult for the system to work with. This is why you stress tested the supply regulators and the price stabilizers, which was, again, a informal working alliance between Texas and other state regulatory commissions that controlled the price of crude oil, and then the majors, which agreed to price off of that price plus transportation. But now you had a big problem. And so as supply dwarfed demand, there's downward price pressure, and imports were starting to go up, and the regulators decided to put in place massive supply cuts. But they said to the Seven Sisters, you guys got to help us out too. And the Seven Sisters at that point were operating the big fields in the Middle East. So now it's not just a question of keeping the price stable, boys. You got to help us on the supply. And so I think at the peak, again, we had 1/3 of world oil production was held off the market by regulators. 20% in Texas and other states, 15% where the companies BP and others in Iraq, in Saudi Arabia, and Kuwait just reduced their supply. Now, the host governments were none too pleased. They're like, what's up with that? Wait a minute. I mean, we guys have you in here to produce. What's up with this slowing down wellhead production? That means less money for me. Whoa, 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 So that started, that started to get the host countries like, what's going on here? No one enjoys having to cut back. But they did. And they did it to keep that price stable. So look at that price in the 1950s. Stable as a cool mountain lake. And this is often relevant for now. So we've lost 20% of world oil production, 15% if you give credit for some of the redirects to Yambo and the Red Sea. But 20%, that's twice as large as the last disruption in history in percentage terms, which was the Suez crisis and war in 1956-57. The Suez Canal was cut, and that was oil was pretty much flowing from the Middle East to Europe back then. That was the recovering OECD. Wasn't going much in China, Asia, except for Japan, but it was a cold winter in Europe too. They really got socked, boy, and prices went through the roof. But we had like 35% in spare. I mean, imagine that. Even before the conflict, you have maybe 3% in spare. 5% would be awesome. In modern times, to have 5% spare capacity would be like, that's ample. They had 35%. There's some history in my book, though. The Texans, even though they had so much spare, they were reluctant to use it. My book has reports of sort of British politicians and commentators finding out, what the heck is the Texas Railroad Commission, and why isn't it making more oil available to freezing Britain, kind of thing. And you had Texas Railroad Commission's guys saying, well, I don't listen to no king. I have Texas policy, not. So you had these two groups who probably never even knew about each other, freezing British subjects and the Texas Railroad Commission suddenly connected because we lost the Suez Canal. And so they were late. And President Eisenhower had to come in and almost threaten them, say, increase production. The Texans were not too quick to produce from their spare, but they did. They did finally.
Were there any other times in the Texas Railroad Commission Seven Sisters time period where that spare capacity really made a huge difference?
It did. So the next big crisis we had was the second Arab-Israeli War, 1967. I think we lost 1 million barrels a day. I don't remember the percentage off the top of my head, but it's in that chart that I put up. I think it was less than 10 because Suez was 10, but it was big. Now then, Texas went up a lot faster, immediately increased production. And so there was no gas lines. There was no oil price shock. No one remembers the 1967 war, huge disruption, or the 56-57 Arab-Israeli war, biggest disruption in history until this one. No one talks about it. Eisenhower didn't have to wear a sweater and put solar panels on the, none of that stuff happened. That all happened on at the third Arab-Israeli war.
What changed there? Yeah.
What changed? Great question. What changed was the year before, 1972, February, March, the Texas Railroad Commission, for the first time in 40 years, ran out of spare capacity. The U.S. gave up. We abdicated our role as the supply balancer. The head of the Texas Railroad Commission called that meeting a damned historic occasion because he said he knows what it means. We're not going to be the workhorse, the balancer anymore. Now spare capacity goes over to the Saudis and the Iranians and Libyans and others. And there's this big myth about the 73 embargo. The actual supply loss was quite small. I mean, in official data, I think we show it at 7%, but honestly, it was an embargo by the Arab oil producers to the U.S. and Holland. And Holland only because that's a storage depot and a shipment center. I think even those data we get, I think those from DOE are probably overstated. But in any event, it was very short. The reason we remember the 70s, not because of the supply loss, it's because OPEC producers, now having wrested control of the market from us, they could just start imposing massive price increases at will, almost month after month. In late 1973, just slamming us. Crude was like something like $3 a barrel in before the war, and then 4 months later, don't quote me, something like $12 a barrel. 4 months. And it's like, take it or leave it. That's what got us freaked out. Not, oh my God, we're running out of oil. It's, oh my God, they can't do that. They just doubled the price of oil and we can do nothing about it, kind of thing. The whole gas lines and the rationing inflation, those were all self-induced own goals. That was mainly bad policy in the 70s, which I hope we never repeat. That's why 73 was different than 67 or 56.
What led to Texas abdicating that position? Was it a constraint of the market, demand growing and maybe declining production?
It was. So 1960s is the hydrocarbon man. The West Europe, Japan, fully recovered from World War II. The U.S., inflationary times, strong growth in the 1960s, and the car culture. And our transportation demand just booms. And the car becomes the central thing in American life. I mean, in a way, I don't know if it's like the iPhone now or what it would be for the last few generations, but you had to be around then. I was born in 65, so I'm not, I remember the end of it kind of, but it was, you see an explosion in OEC transportation fuel demand and fast economic growth. And that caught folks by surprise. Remember, they had been cutting back, reducing investment in the 50s and 60s, and all of a sudden they're hit with this, let's call it a demand shock. And demand quickly overwhelmed supply. And so you saw in Texas, the same thing happened to Saudi Arabia in 2003 to 2008, where demand was overwhelming supply growth. So to keep prices stable, which is their job, they had to increase production out of spare. But they weren't investing enough in total capacity to both increase production and maintain a sufficient buffer to keep prices from spiking. So you just watch that spare capacity chart in the late 60s goes down, down, down. That's Texas saying increase, 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 rise, rise. There's huge demand. We need to we don't want the price to boom because that'll bust. That's an ironic thing. Producers don't want to see price spikes because they lead to price busts. And so, but Texas ran out. So in that, I think it was February of 1972 meeting, for the first time, when they set those monthly quotas, they went to 100% of production. They didn't hold a barrel back. Why? Demand had outstripped supply. We had failed to invest enough. Now then we were, then we started investing in Alaska. That came on later. The North Sea, that came on later. We started those investments, but we didn't have any fields to bring on. We tapped out. That's the reason we tapped out. The same thing happened in Saudi Arabia in 2008. Swing producers tend to abdicate in booms, demand booms, where they get tapped out. Because think about it. If your problem is too much oil, you have a choice whether to cut or not. If your problem is not enough oil and you're out, you have no choice. You're out. And that's what happened then.
It was around this time, I think, around the 73 crisis, and as we switched over to OPEC, that the IEA and strategic storage became a thing. How important is that to the world, then and now?
I think it's really important. So, as I said, what you had is sort of informal group of cooperation between Texas and other oil state price setters, if you will, and the oil companies. And after the shock of 73, mainly a price shock, the OECD countries get together and say, we've got to band together, because what you don't want is people hoarding and undercutting each other and to get oil. So you want to have an orderly response. And so Henry Kissinger goes to Paris and sets up this IEA. And the job was to say, well, mainly let's build and coordinate in the use of strategic stocks, government stocks, because now that we don't have the, let's call it underground buffer anymore. Think about it. That spare capacity was your reserve for geopolitical events or disruptions. We didn't realize we didn't have that anymore. So let's build above ground strategic stocks, and let's agree amongst us to coordinate in their use. Because if it's everybody for themselves, things will go piecemeal, and you won't have the impact. And everyone seemed to agree. It seemed like a reasonable idea, and so that's how the IEA was born. And countries started building reserves, sharing information. Then you needed someone to help. All of a sudden, everyone became a lot more interested in the work that I do. Right, analyzing oil market supply and demand fundamentals became really important, and so the IEA took the role in doing that. And then, during the U.S. really started to build up its reserves in the 1980s. It took a while to get the legislation to pass and start to fill up. And then, there was coordinated drawdowns in 91, and we were ready to do it in 2003 when I was working for President Bush, but we decided to only do it if we saw a major disruption, which fortunately we did not have. And other instances, and we saw just the biggest one now in response to the Iran war, Gulf War III, we call it.
And there's only been just a handful of coordinated drawdowns from the strategic stocks, right? This is very uncommon.
Very uncommon. Wars, and then like Katrina, major catastrophes, major weather events, right? Not too common. It's a little more common to see the U.S., like if there's a tornado or something, localized disruption or damage, the U.S. might lend, a refiner some oil and things. You see minor drawdowns, but you have had some political ones, of course. I don't know if we want to get political here, but there have been, and I won't name which political party did this. Okay, I'm not going to go there. I don't want to sully this conversation with partisanship. But one of the two political parties ordered drawdowns of the reserve for purely political reasons. Once in 2000, and then once in 2022, but I won't say who they were.
People can look it up. Bob, I think staying on the tune of kind of managing the market, I want to double click a little bit on OPEC and maybe draw out how OPEC evolved post the 70 time period when they effectively take over the swing producer role, and maybe even how it started. Because I think one of the interesting anecdotes from the book is that the main character that catalyzes the start of OPEC draws inspiration from a lot of the work that the Texas Railroad Commission did.
Yeah, no, it's great. That's right. Juan Perez Alfonso was a Venezuelan. I think he had been an official, if I'm not mistaken, but certainly New Energy. And he was in exile in the 1950s in the United States. And he observed this market management by Texas Railroad Commission. And he just marveled at it. They just give orders to producers and they adjust the supply and they keep the oil price stable. It's wonderful. And they keep the industry healthy and prices stable and everyone's happy. And even if you have a huge war, they're able to overcome it. It's wonderful. And there was a revolution, and so he goes back, and now he's the energy minister. And then he says, goes to Saudi Arabia and grabs his counterpart and says, we got to go to Texas. You got to see what these guys do. And they did. They visited. I think they hired somebody from the Railroad Commission. You say, show us this stuff. How do you? And so I think the inspiration was to see if the host countries, because they had the big Seven Sisters operating under concessions at that time, and they were like, we need to, take more control here and maybe do what the Texans do to keep the price stable. But in the first years and decades, OPEC as an organization ended up getting more involved in just joint lobbying to get more of a tax take from their concession agreements, right? They focus their energies on that, improving the terms of the tax take. And then when one would get a better one, the others would say, well, Libya got that. You should give us a higher take on this. And so they didn't do the kind of coordination that Juan Perez Alfonso wanted. And I think he later became very disillusioned, actually, and he wrote an article about this, and very, very disillusioned about oil itself, and he called it the devil's excrement. So for the first couple decades, OPEC as an organization, it didn't play a strong market management role. The Texas Railroad Commission did right up until 1972. OPEC was founded in 1960. But after that, look, again, I'll paraphrase Mao Zedong, power in the global oil market flows through the barrel of spare production capacity. And when that power shifted from Texas to Saudi Arabia and other producers in 1972, now market management really began. Now, in the 70s, it was kind of okay. Demand was very strong. They were able to raise prices. But things got tough for OPEC in the early 1980s, right? You had a recession from the oil price spike at the late 70s when you had the Iran Revolution and the Iran-Iraq War, which removed a lot of supply. So you had a supply crisis, a price spike. You had a recession in the early 80s. And then we were bringing on Alaska and we were bringing on North Sea production. So you had a lot of new supply and a slowdown in demand at the same time. This all of a sudden created the first real problem for OPEC. And they started cutting production, but what they found quickly was that Saudi Arabia was doing all the work. Saudi Arabia itself cut production from like 10 to 2 million barrels a day. It was sick and tired of it, while these other producers didn't cut as much. They cheated. They were free riders. And so in 1985-86, Saudi Arabia was like, I'm sick of this. We're done with this. And they decided to ramp up production and crush the price of oil. Vladimir Putin still says that's the reason that we killed the Soviet Union, was that price spike. And the Saudis did that to instill discipline, to say we're not going to be taken advantage of anymore. And so it was after the 1985-86 price spike that OPEC started to do the work of collective supply management with quotas and so forth. And by this time, we had seen the last vestiges of posted prices. Because you have to remember, until the earliest years of the 80s, most crude and products were based on what we call the posted price basis, where they would just announce prices, official sales prices, OSPs. Now, you started to see side markets of spot traded crude develop there. And when you had panics like the late 70s, the prices in these small little spot markets would skyrocket. And if you were a terrified Japanese importer and suddenly lost Iran, you got all you could get from your allocation, and you wanted some more oil, you might start looking under rocks. And if you see a little side market, like an Iranian's got a little extra cargo over here, you pay for it. So that development of that free market pricing sort of undermined the system of OSP. So by the mid-'80s, you got Saudi Arabia saying, we're not doing this all by ourselves. You had market pricing, and OPEC Plus as a group began to do the real supply management work.
How does that erode in the 2000s? What changes?
It worked pretty well. Saudi Arabia would do most of the cutting. You had some problems, like in the 1998 when you had the Asian financial crisis. They had misjudged that, and they increased something called the Ghost of Jakarta. In 1997, they famously increased quotas, not seeing the Asian crisis around the corner. And then oil prices collapse. Again, you had an increase in supply and a sudden demand decline. These are just killers for oil prices. We went down to $10 a barrel. And so climbing out of that took some time. They tried to get Russia to join OPEC. They tried to enlist Mexico to contribute. But they got out of that. Really, what in my view marked the end of OPEC's, because we have OPEC Plus now, OPEC's reign was the thing that ended Texas' reign. From 2003 and 2000 to 2008, you had very strong demand for oil. You had the economy growing at 5 or 6% GDP. You had China with oil demand of 1 million barrels a day itself. Just China was just coming into its real boom phase. They hadn't had enough investment. People had remembered the late 90s when prices were low. So there were lags. We hadn't discovered shale, yet, shale oil. The same old story. Saudi Arabia put oil in, but price only stopped rising, in my view, because the demand collapsed. Now, Lehman was going on there. You had a banking crisis and everything, financial crisis. So, as I say, oil price spikes are either the main cause or an accomplice at the scene of the crime of a downturn. It's not like OPEC fell apart. It's just that they got tapped out.
Hmm.
Now, after prices recovered, they went down from like 147 to 30 in 6 months. Right? 147 in June, 30 by December. Then it comes back, right, to about 100 for 4 years. Those were great times. I mean, OPEC still existed, but they didn't have to do any work. They're really angry at each other. They, in 2011, when Libya went offline, Saudi Arabia decided we need to produce more oil. OPEC should increase. Iran had the rotating presidency at that time, and they don't get along. And so Iran's like, no, we're not going to call a meeting for that. We're not going to allow that decision. And so Saudi Arabia said, well, we're going anyway. And so after 2011, OPEC as an organization, it still existed, but they didn't need to do much, right? Crude was $100. You had strong demand, and shale was coming on, but still demand was pretty strong. We sanctioned Iran. So everything was groovy. You're at $100 for 4 or 5 years. You go through the meetings. You don't like each other. You don't have to worry about that because no one has to cut. No one has to cut. If no one has to cut, then easy peasy. You win, I win. Then came the fateful Thanksgiving Day meeting in 2014 where they had to cut under shale finally. They're like, there's no way we're cutting under shale by ourselves. And it's not just 1 year. It's like year after year after year. And so they said, we're going to have Russia. Russia's got to come down here because now Russian production is growing. We insist that Russia contribute to cuts. We're not going to surrender market share to Russia. Russia was a bigger problem than shale.
Lurking underneath this, there was no spare capacity at the time, or very little.
I'll have to look at my thing. There might have been a little bit. Probably the Saudis usually keep at least 1.5 million barrels a day. So I'll have to go back and look, but it was kind of normal. But if you go back there, if you put yourself in 2013, 2014 and looked forward, every forecaster had supply growth, like outside of OPEC, almost growing by 2 million barrels a day. I mean, the U.S., when shale came on, shale oil, was doing like 1.5 million barrels a day between crude and NGLs. And then Brazil, and then Canada, and then Russia. And so you had non-OPEC supply forecasted to grow by almost 2 million barrels a day a year. Meanwhile, we didn't believe in peak demand back then. So everybody had 1 million barrels a day or so of demand growth. And then everybody assumed, of course, the price would remain stable at $95 a barrel forever because that's what it had been for 3 years. Therefore, that must always be the price, right? And so, but you ask yourself, simple math problem. How do you keep oil prices stable in a market where non-OPEC supply is growing by 2 and demand is growing by 1? OPEC must cut by 1, more or less. And that's what they have forecast. Load-bearing assumption. Go back to anybody's forecast back then. Load-bearing assumption. So I can't imagine a world in which we don't have a swing producer because I know of no one, not even my father. Maybe my grandfather remembers a time when it's impossible for me to conceive that there will not be a balancer here. And so imagine the shock on Thanksgiving Day when the Saudis said, the Russians won't cut, we won't cut. They couldn't agree to cut. They didn't increase. It wasn't like March of 2020. They didn't flood in 1985. They didn't flood the market. A mouse didn't peep. A tumbleweed didn't blow down the center of the town. Nothing happened. Nothing happened to supply. Nothing happened to demand. Everything was stable. The economy was fine. The sun was shining. And crude went from 100 all the way down to $26 a barrel by February 2016. Why? How can that be? No recession, no one flooding the market, nothing happened. And crude oil collapsed. Load-bearing assumption. Everybody's models were destroyed because you knew mathematically if OPEC didn't cut, if you had 2 for supply and 1 for demand, and no one was going to cut by 1, then you knew we're going to have a surplus of 1. And that's 365 million barrels a year going into inventories. And that's impossible to sustain. So price must collapse because now we're back to that pre-1932 period, which is the price shall do the balancing, and that requires lower prices. And the only reason it stopped at 26 in February of 2016, because it would have gone to 16, it would have gone to 6. The only reason it stopped is because Russia had had enough and agreed and took enough pain and said, okay, I'll join OPEC plus. And there was born the world's latest supply manager. They're always born in crises.
A big part of that story was the shale oil game. It wasn't a thing, in the GFC, and by 2015, it was a huge thing. How is shale different than other kinds of oil production, and how has that changed how you view the market?
Shale is much more flexible, responsive to price than conventional oil. It can be brought on stream in quarters. And there's also the process of first you drill the well, then you complete or frack it. And so you can have this phenomenon where you have this like inventory of quickly producible oil that's like half ready to go, right? You drill it, and then you have something, if you have a bunch of these drilled wells, that's called drilled uncompleted wells, DUCs. Then if the price is right, you call up the fracking trucks, the fracking crews, you go out there and you frack it and you produce them. And then you get most of your production in the first couple of years, and then it drops off very sharply. And so it's very different than conventional oil, which takes many, many years, if not decades, to find, develop, and produce. And you get initial production is quite high, and then it slowly drops down. And then as over years and decades, it gets low. Maybe you do some injection to pump the pressure up. So it's very different production profile, timing, and so forth. But the key thing for our discussion is it's more responsive to price. So when prices rise, frackers, hydraulic fracking can be used real quickly to quickly increase production and grab some revenue. When prices go down, because this is a higher cost way of production than conventional oil production, their operating costs are much higher. So when the price does fall, they're the first ones to draw back. They just don't complete the wells. They say, let's wait until we get back in the money. The problem is all those wells have been producing are declining, 30% a year. And so if everyone just stops completing or fracking, the momentum and the production starts to fall off real fastly. That's how we lost 2+ million barrels a day in a few months in 2020. And so you have more responsive. Now, back in 2015 and 2014, it became very fashionable to say that shale was the new swing producer. I never bought this. And I won't name some very famous people who did. But there were people out there who are like, it's okay. Because shale comes on so quickly, it's the new swing producer. And indeed, if you were watching, after 2010, shale oil production ramped up. And that coincided with, the bounce back from 2008, from 30 back to $100. We sanctioned Iran, and shale kind of came on and helped cap the price. If we didn't have shale in 2011, 12, 13, we probably would have gone higher. And so everyone was like, look, that shale boom just kind of capped the price of oil at 100. It's the new swing producer. And so I think there was confidence in OPEC. There was confidence among analysts. It's okay. If OPEC in 2014 agreed to step back and say, we're not going to manage this market. We're going to let shale manage the market, meaning we're going to have shale slow down. Everyone was confident that shale would slow down at like $80 or 70. Below 70, shale would just stop. And so there was a brief moment where people hoped that shale oil would be the new private sector swing producer. And what I think they overestimated in 2015 is how much capital and ingenuity and efficiency the U.S. shale industry could muster and produce, even as prices collapsed from 100 all the way down to 26. We started to see U.S. production taper off toward the end of that, but in 2015, we just didn't get the drop-offs in supply. Investors were still very confident. People just, also, it goes back to Iran can't be closed for 2 weeks. They just can't imagine a sudden collapse of oil price without a recession, the usual causes, or a problem with OPEC. And so neither of those things were going on. So no one can imagine why oil should fall.
Yeah.
It's a complete shock. So all the investors in shale who are printing money are like, keep going, keep going, keep going, burning cash as price went down. They had no idea that we're back in bust phase. And so it stopped only when Russia agreed, to stop at 26. Would have kept on going.
Yeah, one of the things we talk a lot about on the show is the psychology of markets and incentives, and how analyzing incentives can give you a better sense for maybe what to expect. I'm curious to ask you a policy question, because you were in the room when some of these decisions were being made at the White House, and you were on Sunday night on CBS 60 Minutes, and you talked about that the merits of regime change, the goal of it all, makes a lot of sense, and that the strategy that you would prioritize is how do you mitigate the risks of the Strait of Hormuz closing and how do you,
Yeah.
prioritize that piece militarily. So maybe put us in the room in the White House and on
Yeah.
Capitol Hill. How do policymakers make these decisions and trade-offs
Sure.
around energy constraints?
Sure. And I lived this in the second Gulf War. It was a land war, but I was fretting about every gas oil separation plant in Iraq that we took one by one because I knew the more we took, as our ground forces were moving in and we seized more of the infrastructure, I knew the risk of a catastrophic disruption was going down. So I was just obsessed about it. You talk to two communities. If you go to the military folks, which we did, and you say, if we go to war with Iran, can they disrupt Hormuz? For how long? And what would it take to unblock it? And you get a view, clearing those mines, degrading those layered asymmetric means. They have the boats, the artillery, the submarines, weeks, many weeks, right? Then you talk to the oil folks and you do this analysis we talked about earlier. So now you have in your head, okay, instead of going to the markets and saying, hey, we're going to underestimate crude's going above 100 because it's not going to be over in a week. And so you go to the president. What you would typically do is say, look, if we're going to go to war with Iran, you need to understand that our military colleagues tell us Iran's going to, its best card to play is to disrupt the oil supply, get a price spike. That's how they'll that's how they'll react. We're going to go, I would assume you'd go right from the beginning. And I don't know if that happened. I said that in 60 Minutes. I don't know what happened in this case. If it was me, I would have said, see, I'm not a military planner, but the first thing we do is we start degrading the Iranian capabilities to stop shipping because that will shorten the oil and gas price shock, which was certain. Okay. And you have to make sure the president and his advisors and the military understand that. That's your role of the energy guy
Right.
or gal, is to say, look, okay, if we break it, just understand prices are going up. And so that way the president and the military can take that into consideration and then prepare for it. I think forests will fall to print books, PhD theses on the run up to this war and however it ends. And there'll be armchair quarterbacking later. And I don't know all what happened, but when you go to war with Iran, you've got to think about shortening their ability to disrupt Hormuz, or you have a true catastrophic problem on your hands. And if I was in the room, that's the perspective I would have been bringing. And before Iraq, we did. We were ready to go with SPR, Strategic Petroleum Reserve releases, the IEA. We had everything lined up and ready to go. Our military was aware of the need to secure these oil facilities just so we don't have a world, like in the first Gulf War, they torched a lot of the wells. And yeah, the big oil price increase led to a recession. So we didn't want to repeat that.
You opened up by talking about variant perception and how that's what you look for in the market. How does it play out from here, right? Because one of the challenges, you mentioned the word absurd a couple times. Like one of the things people love to do when the markets do make big moves is look back to history to see what happened. Correct me if I'm wrong, but there's not really a good analogy for this in the historical oil market.
So I think about it as the mirror or the reverse of the last collapse of a load-bearing assumption. No one could imagine that crude oil could suddenly collapse from $100 a barrel and start falling towards zero until the Russians agreed to stop it without a recession, without the usual causes. But we learned there is a bottom. In that case, it was a decision by Russia to contribute to voluntary cuts. No one could imagine, in my view, that Donald Trump would ever organize an OPEC meeting and literally chair it. Like literally, he hated OPEC. The guy he wrote books, can't stand OPEC. Yet Donald Trump organized OPEC plus cuts in 2020. There's a bottom. You have a collapse in prices for reasons that are not understood by the market. The market's taken completely by surprise. A load-bearing assumption has fallen. Back then, we can look back and say, okay, what stopped it? Well, Russia did something it didn't want to do before, join OPEC plus. And in 2020, Trump did something he didn't want to do, which is ask OPEC to cut production to raise prices. When does an American president do that? Usually it's the other way around.
Mm-hmm.
Okay. So you can look back in retrospect and say those were the bottoms. If you will, I anticipated both of those. And so I look at this, and my framework is now it's not a bust, it's a boom. As long as Hormuz is disrupted, oil prices will keep rising until one of three things happen. There'll be a ceasefire agreed to by Iran and President Trump. It's not enough for President Trump to walk away and Iran keeps shooting, right? So two to ceasefire, two to tango. So there'll be a ceasefire. That will be the top. Another is the U.S. military, with some allies, will degrade Iran's ability to disrupt traffic, and we will start escorting and get attacks down to a reasonable level, and commerce will flow. And we may have a little bit of disruption, but if that's substantial enough, if we're able to restore the bulk of Hormuz flow after degrading Iran's capabilities, that's another top. And then finally, if neither of those two things happen, the oil price will continue rising up until we discover the new level that induces an economic downturn. What is that level? I'm not a macroeconomist. I'm not sure. It's a lot higher than the old highs, though, because the world's more energy efficient. And in nominal terms, there's been inflation, too. So, don't quote me on it, but the old 147 high is, I think, in real terms, closer to $200. Am I saying we're going to go to $200? Not necessarily. But if we have neither a ceasefire nor a military victory, and this thing remains closed, crude oil prices will rise to enforce the iron law of economics, which says that you cannot consume what you cannot produce. And if we cannot produce 20% of our energy, we will not consume it after we draw down inventories. And if we don't have to get by without 20% of energy, given the inelasticities we talked about earlier, that'll be through economic contraction. And so whether it's 160, 172, 185 and a half, I don't know what the number is nominally, but we will go there and we will discover some new price that basically breaks the back of the world economy.
Historically, Bob, when there are these really big price movements, you end up with like second and third order effects that affect things 20 years later. Like Richard Nixon announces Project Independence in the early 70s, and that contributed to the shale breakthroughs in the late 90s. And you could argue that Japan's really well positioned, or better positioned than others, because of that same time period and how they built up their storage. What second and third order effects do you foresee from the current situation?
I think this is going to traumatize folks because we may actually have shortages. For us, it's paying a high price, and the economic downturn, as bad as it, but in Asia, it's no cooking fuel. Right? I think this plus AI, I think you're going to have a wave of investment in energy efficiency and alternatives to oil. And I don't say that as a guy who hates oil or anything. I don't. I love it, actually. It's my business, my clients and everything. And I think you're going to be thinking, the people are going to think about how to get around the Strait of Hormuz. I would get in the pipeline business going around Hormuz. I think is going to be doing very well. There's going to be all kinds of projects getting, more pipelines. Okay, there'll be the obvious security things. But if you think about it, investors, this is going to be much more powerful than the Paris Agreement or some legislation that sets some heroic target for decarbonization in 2030 and then has weak enforcement or something like that. The usual policy stuff. I think these kind of experiences can really catalyze investment. And if you can bring down, the cost of batteries, or I don't know, more into fusion, or maybe we figure out more money to figure out how to get methane hydrates out of the ground. I'm not saying we're near breakthroughs, and I've always been very skeptical about policy-driven decarbonization. I think there's always more hype to that than there really is sustained economic push because it's difficult for elected officials to vote those policies. But I thoroughly respect, how society and private investors respond to trauma. Because we're like 20 years into these crises and boom-bust price cycles. I think there's just going to be a more determined effort, maybe assisted by AI, and really smart people are going to try and find ways to make us, further reduce the energy intensity of economic growth, and to maybe look into lower the cost of alternatives. It was the craving for light during the Industrial Revolution. I mean, we needed people to be educated and be able to work at night. And they had to often work during the day and then study at night. So you needed to have light. And we only had so much whale oil and turpentine. The market just put a sustained premium on something else for illumination. And that is what drove the search for oil that led to Titusville and Oil Creek and everything. It wasn't transportation. That came later. So I think this experience and its ripple effects is going to catalyze a desire to improve security and logistics and infrastructure, because the Middle East is still going to be a key energy region. That's not going away. But who knows what it's going to lead to in terms of waves of investment, innovation in alternatives. I think it'll be much more powerful than anything under the Paris Agreement. Let me put it that way.
I think that's a great place to end. Our closing question for you, Bob, is your company is growing, the world is changing. What is a skill or a topic that you are personally trying to improve on right now?
Oh, everybody's saying this though. AI,
Yes,
I
yes,
mean,
indeed.
Claude, Perplexity, Chat GPT, which one's the best? You know, I'm old enough to remember when Amazon first started. And I started using Amazon and I'm using it. And then I realized, and I used to think, well, does it have this? And I'd be like, oh my God, it has that. And then does it have one of those? Oh, it has one of those. And I started to realize that the limitation on my exploitation of Amazon was due to my own lack of imagination, not Amazon, right? And I was like, oh my God, this thing can do anything. I can get groceries. Okay. I'm like at that stage with AI. I'm like, I don't think I understand fully the potential that it has given me and businesses like mine and so forth. And so I'm just conscious of that. I just, now I'm very busy, other things going on, but testing, exploiting, using, encouraging my team to use AI to make us better, not to have us think for us. Because what's a blessing for a business like mine is it makes commoditization of data and analytics very free. I got now, for $20 a month, I've got an unlimited supply of data analysts who are just getting more and more, and they don't ask for holidays and no health. I mean, it's amazing. But what our firm is fortunate for is that human element. We call it MPG, but not markets, policy, geopolitics, or Rapidan. It's like the Iran stuff. I'm not sure AI was going to come up with that. It's those calls. How is the Senate going to react if it flips to the Democrats? What are they going to do? I'm not sure there's an AI that where you have to bring that human element in is especially true in case of policy and geopolitics. But the M part of our business, the M of the MPG, markets, policy, geopolitics, is just, it's how AI can help me make that M so much more potent and powerful. And that's kind of where my mind is at. Other than that, my DC band sound policy is going to Houston at the opening of Cira Week on Sunday, and we are going to blow the roof off of the Armadillo Palace.
All right.
I got to get my mind around practicing because all of this Iran stuff is keeping me from practice. So let me know if you're around Houston and on Sunday night. It's going to be wild.
We'll take you up on it. That's awesome. People can find you on X and LinkedIn. And of course, everybody should pick up a copy of Crude Volatility. Bob McNally, thank you very much.
Matt, Daniel, thank you very much. Appreciate it.
Thank you for listening. We love studying defining moments in market history, and we love analyzing history in real time with people like Bob that have spent their entire career driving and studying historic moments. If you enjoyed this episode, the best way to help us is to share it with someone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts. Thanks for listening.